If your portfolio pays you a paycheck but keeps shrinking, you didn't buy freedom, you bought a countdown timer. Today, we're building income on purpose, with rules that keep your capital from quietly bleeding out. Quick favor before we start. Tap like if you want more income, math like this, and subscribe if you're serious about turning investing into a second paycheck. Then comment, are you chasing income or stability first? The old retirement script says, save a mountain of money, then withdraw around 4% and hope markets behave. That plan works for some people, but it can feel like a life sentence. There's another route. Design a portfolio that throws off cash every month, sooner, not magic, not a shortcut, a strategy that trades some upside for income and demands maintenance. Don't rely on perfect timing. The tool set today is high distribution ETFs, especially covered call ETFs. They can pay huge yields, but they can also punish you if you ignore total return and net asset value erosion. Keep your rules in writing. So we're not doing the lazy thing, which is chasing the highest yield on a chart. We're doing the smart thing, building a 5-bucket income system with rules for reinvestment and risk control. By the end, you'll know how to pick funds in each bucket, what red flags to avoid, and the simple reinvestment equation that can help you keep your income high without wrecking your principal. I'm Dave, and this channel is about building cash flow you can actually live on. Educational only, not financial advice. Your situation matters, and every investment can lose money, especially income strategies. Let emotion stay out of it. Let's start with the uncomfortable truth. A 20% yield can be worse than a 2% yield if the fund's price drops faster than it pays you. Income is not the same as return. Return is the whole story. Distributions plus price movement. If you collect $10,000 but your position drops $15,000, your net result is negative even if the monthly deposits felt amazing. Protect the long game. Covered call ETFs generate income by selling call options, usually on an index or a basket of stocks. You collect option premium, then distribute it. The trade-off is capped upside in strong rallies. That trade-off can be worth it if you value cash flow, but it creates a new risk if the underlying chops sideways or falls. You can still get paid while your principal drifts down. So here's our scoreboard. We want consistent monthly distributions, reasonable liquidity, transparent strategy, and evidence that the fund can hold its value across different market seasons. Avoid nasty surprises later. I look at 3 metrics together: distribution yield, total return over meaningful windows, and drawdown behavior. If yield is high but total return is weak, that's often a warning sign. Another key metric is how distributions are sourced: option premium, dividends, interest, or return of capital. Return of capital isn't automatically bad, but you must understand when it's destructive. Now, I'm going to organize this into 5 categories. Think of them like positions on a team: a foundation, a growth engine, a volatility kicker, a thematic satellite, and a stabilizer. Bucket 1 is your broad market foundation with enhanced income. You want something that tracks a large cap index style exposure, but uses calls to lift distributions into the high single digits. In this bucket, you'll hear names like GPIX or SPY. I'm not telling you to buy today. I'm saying this is the job description: broad exposure, steady pay, and behavior that fits a core holding. Your rule for bucket 1: if the fund lags the plain index badly in total return for long stretches, the income isn't worth it. Core holdings must earn the right to stay core. Bucket 2 is your tech-heavy growth engine with income. This is where people want the cash flow of covered calls without giving up exposure to mega-cap innovators. No heroic predictions required. Funds like QQQI or similar NASDAQ-style covered call ETFs try to do that. The goal isn't to beat the index in a melt-up. The goal is to turn growth exposure into a monthly income stream. Your rule for bucket 2: watch how the fund behaves in sharp rallies. If the upside cap is so tight that you miss most of the move, your long-term compounding engine gets weaker. Bucket 3 is the volatility kicker, something tied to an asset that swings hard. When you sell calls on a volatile underlying option, premiums can explode and distributions can look unbelievable. This is where crypto-linked covered call ETFs show up, like BTC-style products. The pitch is simple: harvest volatility for monthly cash flow while reducing some downside compared to holding the underlying directly. But here's the tax you pay. Volatility strategies can have messy years. Distributions may vary, prices can whipsaw, and if you treat this like a core holding, you can sabotage your plan. Over full cycles, it matters. So Bucket 3 has a strict rule. It's capped in size, and it has a reinvestment requirement. You don't fully spend this bucket's distributions until it proves stability through a full cycle. Bucket 4 is the thematic satellite today. That's AIA, AI-themed covered call. ETFs can generate strong income because the underlying stocks are volatile and option markets are active. A fund like AIP I-type strategies can prioritize growth first, then income. That sounds nice, but it can also mean bigger drawdowns. The distribution is not a guarantee of price stability. Don't chase hype headlines. Bucket for rule. Treat it like a satellite, not a foundation. You're buying exposure to a theme plus an options overlay, which means you must expect noise and manage position size. Bucket 5 is your stabilizer, a quality dividend growth or multi-factor equity sleeve with a more tactical covered call approach. Sometimes writing calls on individual names or indexes selectively. Funds like QDVO or an International Enhanced Option Income Fund can live here. The job is to smooth the ride and reduce concentration, not to win the yield Olympics. Now, let's do the math that makes this real. Use a simple example. Portfolio of $500,000, split equally across the 5 buckets, $100,000 each. Adjust calmly when things move. If Bucket 1 yields 9%, that's about $9,000 a year, or roughly $750 a month. Bucket 2 at 12% yields $12,000 a year, about $1,000 monthly. Bucket 5 at 8% yields $8,000 a year, about $667 monthly. So far, this looks like a steady paycheck, and the risk feels manageable. Now, add Bucket 3 and 4, the spicy ones. Suppose Bucket 3 yields 30% and Bucket 4 yields 25%. That's $30,000 and $25,000 per year, over $4,500 monthly combined. So across the whole portfolio, you might see something like $7,000 to $8,000 per month in distributions. That's the hook. But distributions alone are not the win condition. If Bucket 3 drops 20% in price, you lost $20,000 on that $100,000. If Bucket 4 drops 15%, you lost $15,000. That's $35,000 down in principal. Meanwhile, you collected, say, $55,000 in distributions from those 2 buckets combined. Sounds like you're up, right? Not necessarily, because some of that distribution may be offset by price loss. This is where the reinvestment equation matters. High volatility buckets often require you to reinvest a chunk of the distributions to keep the position from decaying and to rebuild after drawdowns. A simple framework is, the higher the yield and the more volatile the underlying, the higher your reinvestment rate. Think 50% reinvestment for the AI bucket and 70% for the crypto bucket. So in our example, you might spend only 30% of Bucket 3's payout and 50% of Bucket 4's payout, while spending most of Buckets 1, 2, and 5. Let's translate that into cash you actually live on. If Bucket 3 pays about $2,500 per month, you reinvest 70% and spend $750. If Bucket 4 pays about $2,080 per month, you reinvest 50% and spend about $1,040. Now you've cut the risky cash flow you spend, but you've strengthened sustainability. Your stable buckets might pay around $2,400 per month, and you can spend most of that, add what you spend from Buckets 3 and 4, and you're near $4,000 to $5,000 monthly. That's the honest version of the promise. You can build life-changing income sooner. But the sustainable spend number is lower than the headline yield suggests because you're funding repairs. Keep cash flow dependable. Now let's talk selection criteria, because not all covered call ETFs are built the same. First, read the strategy. Are calls written at the money, out of the money, or dynamically? At the money calls generally maximize premium but cap upside more. Out of the money calls may allow more growth but pay a bit less. Dynamic approaches can adapt, but you must trust the manager's process. Third, study total return versus a simple benchmark. If the fund's total return is consistently worse than a basic index fund, your income may be masking a long-term leak. Sleep stays possible at night. Fourth, check fees. Option strategies cost money to run, but fees still matter. A high fee plus weak total return is a double hit. You're paying more for less outcome. Don't chase hype headlines. Fifth, check liquidity and spreads. If you're building an income engine, you want efficient entry and exit. Wide spreads can quietly steal months of distributions when you buy or sell. Adjust calmly when things move. Return of capital can be fine if it's tax efficient and tied to option premium accounting. It becomes dangerous when the fund pays more than it earns over time, forcing NAV to grind down. So here's a rule you can live by. Never judge an income ETF by yield alone. Judge it by yield plus total return plus drawdown plus distribution source. Okay, now we'll build a sample blueprint. Bucket 1. Allocate around 30 to 40% to the broad market premium income fund. This is your paycheck base and your stability anchor. Bucket 2. Allocate around 20 to 30% to the tech income engine. This gives you exposure to growth, but you accept that you'll miss some upside during melt-ups. Over full cycles, it matters. Bucket 5. Allocate around 15 to 20% to the stabilizer, like a dividend growth plus tactical calls sleeve. This reduces concentration and can improve risk-adjusted results. Keep your rules in writing. Bucket 3 and 4 together. Keep them smaller, maybe 5 to 10% each. They're powerful, but they're volatile. Their job is to boost income and diversification, not to dominate the portfolio. Mid-video check-in. If this framework is clicking, type the word buckets in the comments so I know you want to follow up with real-world portfolio examples and position sizing templates. Now, let's talk maintenance, because covered call portfolios are not set and forget. The first maintenance task is reinvestment. Decide your reinvestment rates before you start spending. Second maintenance task is rebalancing. If the volatile buckets surge and become too large, trim and redirect into the foundation. If they crash, reinvest distributions and rebalance patiently. Third task is distribution discipline. Don't increase your lifestyle just because distributions spike for a quarter. Build your spending plan on a conservative base and treat spikes as reinvestment fuel. Fourth task is stress testing. Ask, what happens if markets drop 20%? What happens if distributions fall by a third? If the plan breaks, your spending rate is too aggressive. Avoid nasty surprises later. Now, let's address the 4% rule directly. The 4% rule was built on a diversified stock and bond framework with long time horizons. It's about sustainability, not maximizing income. So the right question isn't which one is better. The right question is which matches my goal. If you want earlier cash flow, you might accept more maintenance and different risks. Here's a simple decision filter. If you are still in heavy accumulation mode, you may not need ultra-high yield. Growth plus moderate income may beat chasing big distributions early. No heroic predictions required. If you're close to using your portfolio for bills, higher income can reduce sequence of return stress, but only if your total return stays healthy and you don't destroy principal. Keep cash flow dependable. Now let's talk about the portfolio value stays stable claim. Stability is not a guarantee. It's a management outcome. You can improve odds by diversifying, limiting risky buckets, and reinvesting strategically. Remember our reinvestment equation. Spend more from buckets 1, 2, and 5. Reinvest aggressively in buckets 3 and 4. That is how you keep income while preventing long-term decay. Let's do a more conservative illustration. Suppose your overall portfolio yield averages 12%, but you reinvest half of it. Your spendable yield becomes 6%, or $30,000 per year, on $500,000. That's about $2,500 per month. Not flashy, but realistic, and you still have reinvestment working to maintain the portfolio and potentially grow income over time. Sleep stays possible at night. Now compare that to the classic approach. 4% spend, $20,000 per year, about $1,667 monthly. The income strategy can raise spendable cash flow, but with more complexity. This is why I call it an income system, not a hack. You're trading simplicity for cash flow. You're trading some upside for monthly deposits. And you're trading passive for rules-based maintenance. Now what about picking specific tickers today? I'm not going to pretend one list fits everyone. Instead, I'm giving you a checklist so you can evaluate candidates in each bucket. Checklist Item 1. Does the fund clearly disclose how it writes calls and how much of the portfolio is overwritten? The more overwritten, the more income and the more capped upside. Item 2. Does the fund have enough history across multiple market conditions? New funds can look incredible in a short window. You want evidence, not marketing. Over full cycles, it matters. Item 3. Do distributions match what the strategy should earn, or do they seem too good to be true? If it's too good to be true, it often is through destructive payout policy. Item 4. Does total return keep up reasonably with a benchmark after fees? I'm not demanding outperformance. I'm demanding that the income isn't simply a disguise for underperformance. Item 5. Is the fund diversified enough for its role? A foundation bucket needs broad exposure. A thematic bucket can be concentrated, but then it must be sized smaller. Now let's talk about the emotional trap. Monthly income feels like progress. It feels like winning. That feeling can trick you into ignoring a slow leak in principal until the leak becomes obvious. So you need a dashboard. Track your starting value, your current value, your total distributions received, and your total return. If you don't track total return, you're flying blind. Don't rely on perfect timing. One more point, distribution taxes can change the real spendable number. Some payouts may be taxed differently than qualified dividends. Don't skip this. Taxes can quietly cut your paycheck. Now, let's build a practical starting plan for a beginner. Step 1. Start with Bucket 1 and Bucket 5 only. Build a stable base. Learn how the distributions behave and build confidence. Step 2. Add Bucket 2 for growth exposure with income. Keep it measured. Your goal is balance. You want monthly cash flow, but you still need long-term compounding. Keep your rules in writing. Step 3. Only then consider adding Bucket 3 or 4. Start tiny. Prove to yourself you can reinvest and rebalance without panic. Volatility is fine, but only if you have rules. Step 4. Set your spending rate based on conservative income from the stable buckets. Treat the volatile bucket income as reinvestment heavy until you have a track record. Let emotion stay out of it. Step 5. Rebalance quarterly or semi-annually. You're not day trading, you're maintaining a system. Small, consistent adjustments beat emotional reactions. Avoid nasty surprises later. If you do this right, you end up with something powerful, a portfolio that sends you money every month. With a structure that protects you from the classic mistakes, pending the spicy yield and starving the principal. Now I want to address the biggest criticism. Covered calls underperform in bull markets. That's often true, because you sell away upside. But underperformance is the cost of the paycheck. No heroic predictions required. And for some people, the paycheck is the point. The goal isn't bragging about beating an index. The goal is paying your bills with less stress and more predictability. Keep cash flow dependable. But today's focus is replacing income sooner, so we're leaning into the income layer. Just remember, every extra % of yield is usually paid for with risk, complexity, or opportunity cost. Sleep stays possible at night. Here's the takeaway equation you should write down. Spendable income equals distributions times 1 minus your reinvestment rate. If you ignore reinvestment, you may be spending your future. Don't chase hype headlines. So pick reinvestment rates that match volatility. Higher volatility, higher reinvestment. Lower volatility, lower reinvestment. This one rule can separate a sustainable income plan from a slow emotion disaster. Adjust calmly when things move. We're almost done, so let's summarize the 5 buckets. Foundation, broad premium income, growth engine, tech income, volatility, kicker, high volatility, call income, thematic satellite AI income, stabilizer, quality plus tactical calls. Build the base first, size the volatile buckets small, and reinvest aggressively where volatility is highest. Track total return, not just deposits, rebalance calmly. That's the system. Final favor, if you got value here, hit like and subscribe so you don't miss the portfolio build video. And comment your freedom number, how much monthly income would change your life. Over full cycles, it matters. That's it for today. Stay disciplined, stay curious, and remember, income is a tool, not a trophy.